This is BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, March 6th, and the market's mood is, I would like to speak to the manager of geopolitics.
I woke up, checked markets, and my portfolio did that thing where it pretends it's a disappearing Snapchat message. Also, oil at 90? My gas tank just filed a complaint.
Today, oil spikes on Strait of Hormuz disruption. Stocks sink on inflation jitters plus weak jobs, and we'll connect the dots to your budget, your mortgage rate, and your investing plan without panic buying canned beans.
No beans. Got it. But I did buy an emotional support spreadsheet. Let's go what broke first? The Strait, the stocks, or my confidence?
Story 1. Brent crude hit $90 a barrel for the first time in almost 2 years, with reports of Hormuz traffic near a halt amid the Middle East war. Markets are pricing a real-world bottleneck, not just scary headlines.
So this is like when one person stops in a doorway and suddenly the entire hallway becomes a parking lot, except the hallway is global energy and the parking lot is my checking account.
Exactly. Finance version, oil is a key input cost. When supply routes get disrupted, traders bid up prices because future delivery looks riskier. Higher oil can lift inflation expectations, which then pushes bond yields up and makes rate cuts less likely.
So oil doesn't just hit the pump. It sneaks into everything: shipping, plastics, flights, and the vibe of the Federal Reserve.
Right. For normal people, gasoline and heating costs can rise fast, but the second-order effect is bigger. If inflation reaccelerates, mortgages and car loans can stay expensive longer. Actionable move: stress test your monthly budget with a $20 to $40 more per fill-up scenario and avoid taking on new variable rate debt if you can.
Budget stress test sounds responsible, but emotionally, I'd like to stress test the entire planet. Also, if oil stays high, who wins? Energy stocks and anyone who owns a bicycle.
Story 2. Stocks sank amid a weaker-than-estimated jobs report and inflation jitters as oil surged. The key is the mix. Growth looks softer, but inflation risk looks hotter. That's the worst of both worlds cocktail markets hate.
Yes, the stagflation-flavored smoothie. So the jobs report was weak. How weak are we talking?
One headline: U.S. payrolls unexpectedly fell by 92,000 in February, and the unemployment rate rose to 4.4%. Whether revisions change it later, the market trades the first print because it shifts expectations immediately.
So the economy is slowing, but oil is screaming, inflation's back, baby. That's like your paycheck shrinking while your landlord discovers dynamic pricing.
Good analogy. For investors, in this setup, diversify your risk sources. If your portfolio is all long-duration growth, it can get hit by higher real yields. Consider rebalancing: more cash buffer, shorter duration bonds, and quality companies with pricing power, rather than chasing the most rate-sensitive names.
Stop investing like rates are going back to 2021 next Tuesday. Also, if jobs are wobbling, is this where you tell people to update their emergency fund before they update their watch list?
Story 3. The jet fuel angle. Analysts warned a surge in jet fuel prices tied to Gulf supply disruption could push up airfares, and United's CEO said fuel will hit results, even as travel demand hasn't taken even a tiny step back. That's margin pressure in plain English.
So airlines are like, planes are full, but our fuel bill chose violence, which means the consumer gets the premium seat experience in economy pricing.
And don't miss the currency piece. One headline noted the U.S. dollar cut gains after the unexpected drop in February payrolls. When growth data weakens, it can cool the dollar, but oil-driven inflation fear can pull the other way. Net, FX is signaling uncertainty, not clarity.
So my takeaway is oil chaos can keep rates annoyingly high, weak jobs can hit stocks, and airlines might pass the pain straight to my vacation. Cool, cool, cool. What's the grown-up checklist for today?
3 quick moves. 1. Run a 2-month cash flow buffer check. Fuel and groceries first. 2. If you're investing, rebalance rather than react. Reduce concentrated rate risk and keep dry powder. 3. If you must travel soon, price flights early and compare flexible dates. Fuel shocks can show up fast.
And please subscribe to BD Daily Finance News Podcast, because my coping strategy is understanding the chaos, plus mild roasting. Leave a comment. Are you hedging with energy, hiding in T-bills, or just walking everywhere?